2015 was a stellar year, as was 2014. I think those years were all about yield compression. There was clearly more money in the market trying to find product than there was actually product available. So as a consequence, we saw phenomenal yield compression. So prime yields now for both offices and industrial, sub 5%. I think the difference about 2016, although the volumes of capital are still there, it's being more selective in the product that it's choosing. I think it's seeking to position itself on assets which will take advantage of the rental growth that we're now seeing coming through the market. The investment market came back after the recession a lot faster than the occupational markets have. Now, through 2015 and into 2016, we're seeing the occupational markets now catch that gap up. And we have a situation now where we have a strong investment market which is underpinned by an equally strong occupational market. What this provides now is rental growth. The office market has already seen good levels of rental growth, and indeed we are projecting between now and 2019 4.2% per annum on average in the city centre. Now Manchester's only 2.1%, and indeed that's above the UK average for large cities. So, and in the industrial sector we've already seen a lot of rental growth, and I think the growth going forward will be slightly more modest. But the change in that sector is we're seeing big demand for the urban logistics in the city, within the conurbation. And as a consequence, I think we'll see rents go forward for the smaller buildings. Over £710 million of buildings were transacted in the city centre alone last year. Now, I just don't think we'll see that volume in 2016 because an awful lot of the buildings that could be transacted or were ripe for transaction actually transacted last year. That being said, we've got £480 million of deals under offer in the city centre already this year, albeit in two large deals. So although at the end of the year the transaction volume in terms of sterling may look like it was the same as last year, I'd be very surprised if we have the same number of deals. We've seen an awful lot of funding of pre-lets last year, and this is now almost commonplace, and it's a natural extension really of investors' requirements for prime well-let stock. This year we are seeing a lot more in the way of spec development. The spec market has very much been focused on the big distribution units, and I think this year we're already seeing more smaller buildings become potentially spec opportunities, really capitalising on the increasing demand for urban logistics.